Well, it is with a great sense of excitement that I'm here along with Chris and with Daryl, and I hope you've spent many hours with the three of us in the past, but we are here to do something special. Now, I sat down and I was counseled. This is the last podcast, the last video of the year, and keep it simple, keep it light, and keep it short. And as I thought about that, I thought, well, the natural topic will be what lessons did we learn in 2020? And we did learn a lot of lessons. And it turned out when I did a search on the internet about lessons learned from 2020, that there are about 100 articles and lists of things that anybody could go read and get a sense of some of the things that happened, and they won't be surprises to you. But then I thought, why give lessons that everybody else is already doing that? What about the best lessons that came out of the work of our foundation? And I've got to tell you, I can maybe take credit for a little bit of that work, but the real work was done by Chris and Daryl. And so I asked whether on December 30, when other people are winding down and enjoying their life, they would join me and look back at 2020 and figure out what is it that we did in terms of sharing information with investors that represent important lessons for a lifetime, not for the next year, but for a lifetime. And I was hoping we would come up with 10 because I always want to come up with 10 at a minimum. And by golly, it turned out there were at least 10 really genuine, good, I even think great, because they're good teaching moments, pieces of research that these two gentlemen were responsible for. And that's what we're going to spend a few minutes here today talking about. So, and before we get going here, I've got to issue one major thank you. Actually, there are a whole bunch I'd like to, but I don't want to bore you. A lot of you took the time and sent us a donation in the last month. I was pleasantly surprised when I got up early this morning to see how many PayPal donations were made. We really appreciate it. This all helps us in what we've got coming in the next year. And we're going to spend a minute at the end of this discussion talking about some of those things that we are working on to help you. So we've got 10 of them. They all have, almost all of them have some numbers to go along with the conversation. And Daryl and Chris have been nice enough to put together the documented, the tables or the graphs that we've used in the past year to discuss these items. Many of you are on a podcast and you can't see this information. We're going to discuss it as simply as we can, but there will be a link to each one of these tables or graphs in the write-up, whether it's YouTube or the write-up for the podcast. So I'm glad you're here. I'm sorry that this isn't a quick and dirty year-end piece, and I am so glad that we have some of you here to spend some what I hope will be valuable time for you. And let's get going. Daryl, you turned out a whole bunch of great work this year. I counted over 70 tables and graphs and things that you did that, and some of those, as you know, we're doing all those distribution tables that we do and the fine tuning tables that we do. But I liked one piece in particular. And in fact, when I saw it, I was excited because it represented something very similar to a graph or a piece that Callan puts out that shows the returns over the last 20 years of a whole bunch of different asset classes. But you went over the top. You took our four major asset classes all the way back to 1928. You let us look 1 year at a time at how those major asset classes, along with the four fund strategy, the balance of all four, how would that have looked? And what did you learn when you look back at that wonderful, I think you call it a quilt chart.
Well, that was
you have it right there.
Actually, one of our listeners called it a quilt chart. I don't remember what I called it, but I thought that was an excellent term because that's exactly what it looks like.
Yeah.
So yeah, we spent a lot of time this last year delving into quantitatively understanding the variability of returns. How do they vary over time? How do they vary with respect to each other? And while a lot of qualitative understanding was already present in what that means, going through and doing some quantitative work gives us a better feel for exactly how those variability things happen, or what that variability means. So let's bring the quilt chart, the infamous quilt chart, up here. And this, as Paul mentioned, this is 92 years worth of data, 1 year at a time, the four U.S. asset classes and the four fund portfolio. It's quite a bit of data. So one of the things that came out of this is that the returns rankings from 1 year to the next are very variable. And they don't always fall the way you think they should. 20 times out of the 92 years, the returns for the asset classes fell in the order of their quote expected unquote returns. Small cap value, small cap blend, large cap value, large cap blend, or the S&P 500. So that's 22% of the time out of the 92 years. But on the flip side, 15 out of those 92 years, 16% of the time, it's exactly the opposite of what you would have expected. So they're variable and they're unpredictable. If you're looking at the video, you can see the blue ones are the ones that are in the order, and the red ones are the ones that are in the opposite order. One of the things that comes out of looking at this 92 years of data, though, is that 53 of those years, 58% of the time, small cap value did outperform the S&P 500, or basically the US market. So while things are variable and the way the expected returns stack up is not predictable, more often than not, the one with the highest expected return outperforms the one with the lowest expected return, which is sort of what you would expect, but this kind of quantifies it, or quantitatively defines it a little bit. If you go and look at periods now by decades, let's say 1 decade at a time, things get less predictable, sort of, but in some ways more predictable. Only 2 out of those 9 decades do the actual expected return rankings rank out the way you would expect them to. So it's about the same as the 92 years. So the rankings are about the same when you look at it by a decade by decade. But now, instead of the small cap value outperforming large cap blend only 58% of the time, it does it almost 2/3 of the time, 67% of the time. So that's a little bit more. Once you look at a little bit longer time horizon, things get a little more quote unquote predictable, at least based on the past data. If you go and look at 20-year periods, now things are starting to sort of shake out the way you might expect. 3 out of the 4 of those 20-year periods, the rankings were exactly as you would have expected based on their expected returns for the asset classes. And in the one where it wasn't expected, it's still not very unusual. But 4 out of 4 of those 20-year periods from 1930 or 1940 rather through 2019 the small cap value outperformed the S&P. Every one of those 4 independent 20-year periods.
Now, Daryl, I might just add something here as I look at this 20 years, and boy, these results do certainly make the case for patience, and not, it isn't that we don't want you to get what you want when you want it. We just know that people normally don't get what they want when they want it, which is now when it comes to investing. But I'm thinking about all those young people I'm going to be talking with next year. And I look at over the 20 years where bonds and T-bills, government bonds and 1 month, 30-day T-bills guaranteed by the US government in both cases. But when I look at what happens over those 20-year periods, and I think of those, I think it's something like 25% now or more of young people are putting any money in stocks at all. They're keeping it someplace safe like bonds. And I think, God, please take a look at this table and understand what the payoff is for the patience of waiting for these returns to come to you, even if you only got the S&P 500 or total market index. It wasn't shabby compared to the returns of the fixed income. So that to me is a huge lesson for young people. But go ahead. I'm sorry to interrupt.
No, you're absolutely right. We'll talk about patience next. But one more thing to notice here is if you look at the 4-fund combo, this is the US 4-fund combo, which is basically 25% of each. Well, it is 25% of those, all 4 asset classes: small cap, value and blend, and large cap, value and blend, equally allocated. It sits right in the middle, which is kind of what you would expect every one of those 20-year periods. And its return is not bad. In general, it's anywhere between 1.5% and 2%, or maybe a little more even in some cases than the S&P 500. So that's.
And I got to weigh in there too, Daryl. I got to weigh in because this is a biggie.
Okay.
There are people who truly believe in terms of equities, the only place to invest for the long term is either in the S&P 500 or the total market index. In fact, the total market index is the first mutual fund to have over $1 trillion invested in it. I mean, this is really amazing when you think of the confidence. But remember, the S&P 500 and the total market index have almost the same return. So when I look at how the S&P 500 did, and I look at the expectations for the total market index, I would say that they would both do about the same. So here's what I'm seeing that really makes a big difference. I look at the 4-fund combo, and which of course is 25% in the S&P 500. And I see that in one of the 4 20-year periods, the return was less than 10%. And in a couple of cases, it was over 15%. And then I look down at the S&P 500 and I see 1, 2 20-year periods that it underperformed the 10% that we normally think about when we think about equities. But in the case of the 4-fund combo, it underperformed by less than 1%. It compounded at 9.1. But those 2 20-year periods, the S&P 500 made less. It was 6.8 and 6.1. Boy, that is a big, big difference. And of course, then I have to ask, can you tell us, either one of you, how much more risk that you take being in the 4-fund strategy versus the S&P 500? Chris, what would you say?
We'd have to go back to your tables that Daryl's got, and I'm sure he's got them somewhere nearby. It's a few percent in drawdown risk, right, Daryl?
Yeah,
added. I mean, it's not very much, but
we have the data later.
Oh, do you? Okay.
Right. At least some of the data in terms of standard deviation and drawdowns and things like that.
All right. I'll be patient. Sorry. That's
okay.
Let's go on.
Yeah, lost my thought. Well, okay.
My fault.
So no. So, well, I guess kind of the bottom line here to me was that things are variable. They're not predictable. Uh, so what are you going to do? Well, the answer kind of is to just, in the infamous words of John Bogle, is to stay the course. Okay, because if you look at how things here, so if you look at how things vary over time, going back to this chart here, it's kind of hard to figure out what's happening here when you look at this in a longer term scale. So one of the things that I spent some time this past year doing was looking at how relative performance of one asset class or one portfolio compared to other portfolios. And the perfect, or one of the perfect, or maybe a good way of looking at that is called a relative performance chart, or as John Bogle referred to it and popularized it, it's the telltale chart. So this is briefly what a telltale chart is. On the left here, you can't see this on the podcast, but basically it's two growth curves of the S&P 500 and the US 4-fund combo portfolio. And so when you look at these numbers, or when you look at these graphs, these lines on here, it's kind of hard to figure out what the relative performance at over any one interval is. You know, over the course of these 90 years that the US 4-fund did much better than the S&P 500, but it's hard to tell what's happening in between. So if you take the US 4-fund returns, or growth actually, and divide it by the growth of the S&P 500, you get what's called a relative strength, or a telltale chart. And that's what's on the right here. You can't see it on the podcast, but basically it shows how the growth that you ended up with at the end of the 92 years came about over time. And when you look here, you can see there are flat periods, and you can see that there are times when things really grew much faster. The US 4-fund grew much faster than the S&P. There are a few times where it didn't do as well. So when you take and you look at that over time, and you again look at the 9 decades data, again, if you remember back to the quilt chart we had for the decades, you can see how one decade after another, the decades are most of the time the US 4-fund outperforms the S&P 500. Sometimes that ride's not very smooth, though. If you look at the 1970 on the chart on the video, if you look at the 1970s, okay, even though over the decade the US 4-fund had 50% higher growth over the S&P 500, the first 4 or 5 years were not fun. They went down quite a bit. Similarly, if you look at the decade of the 90s, the S&P 500 outperformed the US 4-fund, but that outperformance didn't come until the last 2 years of the 1990s. Really, is when it fell, when the US 4-fund fell down a little bit. So it's variable.
And by the way, Daryl, if I could just note there, it isn't that the 4-fund strategy lost money in those final years, because that it did make money, but the S&P 500 just absolutely ran away from the pack.
Right.
So relatively, it did poorly, even though somebody could say, well, I did okay. But
right. That's exactly true. That's the difference between what the telltale chart does is it tells you how you performed relative to something else. It doesn't say you lost money, or even really that you made money necessarily. It's just that you made less or lost less than the other asset that you're comparing yourself to. One of the things you'll notice on here is there are also periods where there's relatively flat performance, where from the beginning of one period, like let's pick 1980 here, to the end of 2000, those 21 years, the US 4-fund essentially had the same growth over that 20-year period as the S&P 500, which, if you remember your history, is actually kind of amazing, because the S&P 500 was the US market, was pretty hot during those 2 decades. So let's kind of break this down a little further here. So if we're talking about the US 4 fund, there are periods of time, 20 years from the mid 40s to the mid 60s, 8 years, basically the late 60s to the mid 70s, 17 years from the early to mid 80s to the early 2000s, where your performance was even. But what happened at the end of that period? Okay, let's take an example here in the early 70s, late 60s through the mid to late 70s, that 8-year period where you had essentially the same performance as the S&P 500. What happened at the end of that? Well, over the next 7 years, you outperformed the S&P 500 by 69%, 7.8% per year. What happened in the next period of time? Well, there were 17 years where it was pretty flat, okay? But starting in about 2001 through about 2006 or so here, it looks like 7 maybe, you outperformed the S&P 500 by almost 60% over that 5 years. That's almost 10% per year. So what does that mean? To me, what that means is that you have to have patience, because there will be times when you won't necessarily lose money. You just may not make as much as the S&P 500. But when the inevitable, and at least in the past, when the inevitable has happened, that things turn around, you make up ground, and you more than make up ground. You pull ahead quite dramatically over a few number of years. Most of your returns come in relatively short periods of time, but boy, do they come when they do.
And I might mention, Daryl, that in a way, even in the business of investing, there are a lot of neeners, and there are people who may believe the only place to be is the S&P 500, and when it's been so much better than small cap value has been, then it's easy to say, I told you so, and that's one of those neeners. And people feel like they made the right decision. And so as I look at this chart, it says that I can go for 15 to 20 years of neeners quite often over a long life, where you will just feel like you're out of sync with what you believed was going to happen. And that is certainly a part of successful investing. John Bogle says it, Buffett says it, almost everybody that has been a long-term successful investor will say, get on course the best that you can and stay the course. Or if you are the type, and they don't necessarily say this, but I'll add it to the list. If you're the type that can't stay the course with one strategy, maybe what you do is you find 2 or 3 strategies. You divide your portfolio up into different strategies that have evidence of a lifetime of success. And maybe that diversification of strategies will help you stay the course for the long term.
Yeah.
Sorry. Once again,
I think you're right. Yeah. I think there are 2 things that come out of that. One is what Chris always says, and that is that if you want to do better than the market, you got to be different than the market.
Yeah.
So that's one thought process. And the other one, what was your second point again, Paul?
At 77, this is the problem with being 77. I have no idea.
He said diversify.
Yes, that's right.
He said place multiple bets, right? If you don't put all of your confidence in a single bet, put it in multiple asset classes.
Strategy diversification.
Yeah. Paul, I listened to today's podcast that you just released this morning, and you said at the end of it, this was the one on 12 Vanguard funds for retirees. And at the end, you said, investing's not complicated. You can learn this stuff. I would add to that, investing, the principles of investing aren't complex, but they're unnatural. It's not it's not something that comes naturally to a human being to learn lessons over decades. We tend to learn lessons over minutes, hours, days. You know, we've been evolved to touch the hot thing and learn don't touch the hot thing again. And it's so easy in investing to learn the wrong lesson. You know, you could get in an asset class for 2 years and have it perform poorly and draw the conclusion that I should never be in that asset class again. And that's going to be such a disservice to you over the long haul. And so I think these charts that Daryl has made are just fantastic at teaching the importance of patience, and also the value of respecting long-term historical data that isn't reflexive. It's not easy. It's not natural, right? It's an unnatural learning process, and that's what makes it hard.
And you, by the way, and you live with the worry that if you keep trusting something that's not working out, that it won't work out, and then where will you be? And I've seen that in so many people afraid to sell something because they know the minute that they sell it, it's going to take off, and so they hang on and they hang on. Oftentimes, those are individual stocks that, in fact, never do come back. But when it comes to indexes, at least in the past, they have almost always come back.
Yeah, one last point on this chart, because and it'll apply to the next charts I'm going to show too, is that this is a relative strength chart that shows if you had invested in the very beginning of this at about, I guess it's 1930 here. Okay, so an example in the late 60s to mid to late 70s, there was a period of time there where relative to the S&P 500, your growth did not keep up. However, if you would have started investing in the early 70s, say in 73 or so, over the next 12 years or so, you would have had you would have had a much better return than after you had broken even if you had invested earlier. I'm not saying this very clear, but clearly, but where the investor who had invested back in 1930, he had almost 70% gain over the following 7 years. If you would have invested in 73 instead of waiting until you broke even again at 77 before you measured your gain, it would have been significantly more. I don't have the numbers here, but this is a log scale, and so when you can look at the video and see what it looks like, it just depends on where you invest. So moving on now, I guess this was the U.S. 4-fund portfolio. After the 92 years or 90 years here, I guess, you had 5.7 times as much growth as the S&P 500. If you go now and look at an all U.S. value portfolio where you have U.S. small cap value and U.S. large cap value, 50-50, and you compare it to the S&P 500, the character remains the same. There are periods of relative underperformance and dramatic periods of relative outperformance. But overall, at the end of the 90 years, instead of being 5.7 times the growth of the S&P 500, you're up to 9.6, almost 10 times as much growth. This is for lump sum investment on day one. If you go and look at U.S. small cap value, again, long periods of outperformance or underperformance, followed by periods of dramatic outperformance, in some cases as much as 20% per year compared to the S&P 500. You also end up with 24.3 times. So what does all this mean? To me, this means that you have to have patience. Whichever strategy you pick, you have to have patience to let it ride. You've picked this strategy, if it's one of these three or other strategies that are different than the S&P 500, and you picked them because you wanted to get a different return than the S&P 500. So you shouldn't be, it's easy to say this, hard to do this. You shouldn't be disappointed necessarily when you don't get the performance that you thought or that the market is getting, because you don't want the performance that the market is getting. You want something different.
Now, Daryl, I've got a question, because this leads to a thought about what we could do next year here that would be interesting, particularly to young people. This is all lump sum, as you say, which means you put money in on day one, you don't add, you don't take it out. And
I can
what would
feel
you
it coming.
think? Pardon?
I can feel it coming.
Yeah. What would it be like if we simply dollar cost averaged over 92 years? I know that that sounds like that's an improbability, but what about the newborn child? 92 years is actually a possibility, but it would be a question: how much more would you have from small cap value compared to the S&P 500 based on dollar cost averaging? I have no idea, but I'm guessing it's more than 24.3 times the S&P 500.
Well, I'm sure Chris has the tools that he could use to follow the two funds for life process, where and apply it to other portfolios, I suppose, where you dollar cost and average in over time, and then you take it out over time and look at a life cycle of 90 years or 92 years or whatever, and compare that to the S&P 500 having done the same thing, or total U.S. market, or even a three fund type portfolio, U.S. international and which I guess is two funds. But
and by the way, Daryl, I was watching Chris's eyes while you were saying that to see whether he was receptive to the idea.
Yeah. We can. So I do. Daryl and I do a little bit of a different kind of analysis because with the focus on two funds for life, it's really when you have this glide path that's changing the asset allocation over time, it's important to test it at different start dates. And so I do a rolling return analysis where most of Daryl's, perhaps all of Daryl's analyses, I think, are like a sequence of returns based on one set of history. But yeah, we could do some of those kinds of analysis next year, and it wouldn't be that hard. It'd be interesting.
Great.
Right. Okay, so let's see, what were we going to talk about next? We talked about all of that. Oh, yes. Okay. So one of the things that Paul was mentioning here is that this isn't that hard, okay? You don't need a huge portfolio, like the ultimate buy and hold. You can have that, but if that's not your style, you don't need that to get outsized returns. One of the things we looked at over the year were simple portfolios, or as Paul calls them, no nonsense portfolios. We looked at a suite of, I don't know how many are here, 12 or 13, something like that. And of varying from the S&P 500 and total US market to four fund portfolios, or US, worldwide, all value worldwide. And we looked at, in this particular time, because we had a problem with data availability only going back to 1990, we only looked at the last 30 years. But when you look at those last 30 years, what you see is that the S&P 500 and the total US market basically returned about 10.2%. And you look at the other portfolios, there's a three fund equity portfolio, which is basically the total US, total international. It excludes the bonds for this analysis. US with plus 30% of US small cap value, world plus 30% US small cap value, the all US value. There's a core four portfolio, which is based upon Rick Ferry's work. There's the US four fund, the world four fund, and the all value world. And when you look at those and remember that the total US market basically returned about 10.2, four of these alternative portfolios had superior returns over the 30 years by 1% or more in a year, percent or two, up to almost 2% more over those 30 years. The total value US plus, or total US plus 30% US small cap value had 11.4%. The all value US two fund portfolio had 12.3%. The US four fund, which we've talked about earlier, had 11.8%. And then the all value world, which is large and small value US and international, had 11.1%. So there are four simple portfolios that you can use. And in the past, last 30 years, have outperformed the total US market. So when you look at how things vary, this is going to be a little bit difficult for the podcast listeners, but go see the charts. I'll describe the chart here. We've highlighted for each one of the 1 fund, 2 fund, 3 fund, or 1 fund, 2 fund, and 4 fund portfolios, which one had the best and worst returns. And when you look at it, the best returns are in green and the worst returns are in yellow.
And this was by the year.
Yeah, by the year across the spectrum of these 13, or how many there are. How many are there? 8, 11, I guess, portfolios. And when you look at this, what you see is that the S&P 500 there's a bunch of green and a bunch of yellow, which basically means there were a lot of times when it was the best and there were a lot of times when it was the worst. The US total market, not quite so much. The ride was a little smoother and gave you the same return. So that's a better Sharpe ratio probably than the S&P 500. But when you look at the other 4 portfolios that we had, the US plus 30% US small cap, all value US, US 4 fund, and all value world, the all value US only, that's US small cap and large cap value, it had a pretty rough ride too. It gave you a good return, the best return, in fact, of the ones we looked at over the 30 years, but it had a very, very rough ride. Lots of green and lots of yellow. When you look at the all value world, which also had a good return, 1% or so better than the total US market, it also had kind of a bumpy ride, although most of its bumps were on the upside. But there are 2 portfolios as you went through that delivered a better return, 1% or more better return than the US market, and neither had the worst return in a given year or the best return in a given year. So its ride was a little smoother, and that's the US, total US, plus 30% US small cap value, and the US 4 fund portfolio. So there are 2 examples of portfolios that have simple portfolios that have smoother rides and deliver superior returns when compared to the US total market and the S&P 500 in the past, specifically the past 30 years.
Can I add something, Daryl, here about the last
Absolutely.
30 years? Meb Faber, when he spoke, I think it was in Florida, he had one of his graphs showed it could have been a dozen, maybe more strategies over a very long period of time. And they were all supposedly legitimate strategies made up of common asset classes. And they did, in fact, have a fairly narrow range at the end of time. Sometimes they were at top of the list, sometimes they were at the bottom, but they kept coming back and doing their thing. It is interesting to me to note that these are all legitimate strategies, but the range from the top to the bottom, is about a 5% difference. And that's a big difference. And the question is, in my mind, is that just a random event, or is this something that an investor should be able to, and I say count on? I mean, the probabilities would be very good that they would get an additional return by exposing themselves to more than just, for example, the total world market, 7.3%, is all large, all big companies, basically, because it's cap weighted. Big companies in the US, big companies overseas, as opposed to the all value worldwide, which is a combination of big out of favor companies and small out of favor companies. The difference there is about a 4% difference in return.
Yeah.
And is that legitimate? Are we just data mining, or is this a substantial piece of evidence that young people should be aware of?
30 years is not a long period of time.
There you go.
And so I hesitate to say that it's not data mining. On the other hand, there are a lot of people who only make investment decisions based on a lot less history than this.
Yeah.
And so I have a feeling there's something there. And it's quantifiable to the extent that you can look at and consider the last 30 years representative. The degree to which you do that is the degree to which you can believe the data that you have here.
Yeah. Chris, what would you
add? It'd be better to look at more data. And we actually had Chris will talk about this later, but we actually have more data now that we can go back and look at longer histories.
Yeah. Good.
I think in a lot of respects, what you just walked through, Daryl, with this chart is it's a sign that we can confirm what the academics have already found. Fama and French won the Nobel Prize for identifying size and value as additional factors that had a long history, presumably a statistically significant history of delivering value, something beyond random. And so what you've shown in this chart is that when we tilt portfolios a little bit towards small and a little bit towards value, whether we do it in the US or we do it in the world market, whether we do it with 4 funds or 2 funds, it does increase returns, which is what we would expect. And it also provides a level of diversification because those factors perform at different times than the market risk factor, which is what you get when you don't tilt. All you get is the market risk. So I think there's a lot of academic evidence that putting some part of your portfolio in small and some part of your portfolio in value is going to give you a little added amount of diversification, a little amount of added return. And then it really comes down to behavioral economics and behavioral finance. How confident are you in that bet? How disciplined are you at sticking to it? How willing are you to tolerate the added drawdown or the tracking error you're going to see as a result of it? And those are really, really hard questions to answer. They have to be answered independently, individually. But I hope in the work that you've done here and the work that we do at the foundation, we're helping people make an educated decision about it so that they choose something that's appropriate for them.
Yeah, I guess one final thing here I would mention is that, for example, would I say that the US 4 fund at 11.8 compared to the total US market at 10.2, would it always deliver a 1.6% performance over a 30-year period? No. Would I believe that it would outperform the total market over that period of time? I think I would. It's hard to say how much things vary over time. Sometimes it would be more, sometimes it would be less.
That's great. So
moving on, also for these no nonsense portfolios, we won't talk about them so much here, but on the website, and we'll leave it up here for a second or so, and you can look at it on the podcast video. We have different statistics in terms of growth and up and down years and standard deviations and things like that for the 11 portfolios that we just looked at. So you can go in and you can delve into some of the little more detail there. Paul?
Great stuff. Thank you, Daryl. I really appreciate all the hard work that you've done. I want to spend just a few minutes talking about the ultimate buy and hold strategy. This is a strategy that Rich Buck and I started writing about probably 20 years ago. And it's basically the same discussion today as it was 20 years ago. And what we did was we started with the S&P 500. That was the total portfolio. And what would happen if you just through a series of baby steps, and they really are baby steps, what if you made changes? So we showed the impact of adding 10% large cap value US to a 90% instead of 100% the S&P 500. And that gave a slightly higher return of about 0.2%. And then if you added 10% in small cap blend, that added another 2%. And by the way, your original investment of 100,000, instead of growing to 15 million, grows to about 18 million. And then we add 10% US small cap value, and that adds about 0.3%. And then we add 10% in REITs, and that then brings it up to another 10% to 11.4%. Remember, we started, I guess I didn't tell you, at 10.6 with the S&P 500. And then in one fell swoop, we bring in 4 major international asset classes: large cap blend, small cap blend, large cap value, small cap value. And that increased those extra 4 asset classes by 0.6%. And then finally, the one last asset class is emerging markets. And over the last 50 years through the end of 2019, and we'll be updating this table here in the next month or so, the $10,000 grows to about 37 million versus 15 million with the S&P 500 only, and a very similar volatility factor in terms of standard deviation. Now, there are no new lessons there. There was no reason for me to bring you this table, because this is the same story we've been telling for years, except what happens next shows a new lesson, if you want to. And that is, we then took it into portfolio 8, where we eliminated all of the blends. We eliminated the REITs, and we had an all value portfolio. And in the past, that all value portfolio produced a better return. And now at the end of 50 years, we had to go out 50 years to see that you can have a couple of bad years in relative returns, and all of a sudden, instead of being better, portfolio 8 has a lower return, not by much. You wouldn't be disappointed, but it didn't get the premium that one would have expected. So talk about the impact of time and the probabilities that things won't turn out exactly as you thought, does to me suggest that the idea of building a portfolio with many different asset classes, US, international, large, small, value, growth, REITs, emerging markets, there's I think a lot of wisdom to doing that, rather than maybe narrowing into a few. The evidence, probably when we add another decade to these numbers, will likely be that the all value portfolio will have done better, but we don't know. So I think there is a good lesson in that. And that now, by the way, brings me, Chris, to you here. And it's this whole topic. You brought it up earlier, this being able to predict more of the past than we could before. And now we're talking about trying to predict the past, not the future. You want to take us into that discussion?
Yeah, so I think one of the big learnings from 2020, and this kept me and Daryl both busy for at least a month or two, was that we could do a little bit better job extending our analysis of some of the asset classes back to 1970. And the realization was that there was some publicly available data available online that reported some of the asset classes we didn't have a history for going back to 1970, namely emerging markets, international developed markets. And so working with Daryl, we came up with a way to, instead of substituting, which is what we did in the past, for asset classes we didn't have, we built some new asset class return histories going back to 1970 to fill in those gaps. And what we would expect by doing that is that we'll have a little bit more diversification and a little bit more realistic view of how much international assets help or hurt going back to 1970. To give you an idea, in the past, if we, for example, no longer had a history for international small cap value, we would have, and Daryl, correct me if I'm wrong, I think we would have substituted the other international asset classes we had, right? So we would have gone to international value and large cap blend. We would have spread it across the assets we had. And so the farther back you went, the less tilted the portfolio was to small and value and emerging markets, and the less international it was. At some point, it got to be, I think, a little more US. Is that correct, Daryl? Or did it get more large and blend? We can't hear you right
We
now.
can't hear you, Daryl.
No, you got to be
Okay, you're back.
smarter than your equipment. Yeah, I think that was true in the past. What we did was we tried to maintain the international U.S. split first, with respect to the progression of addition of asset classes, but you couldn't always do that, and it became very concentrated in some of the sub asset classes within the individual geographical diversification. So it was much less diverse.
Yeah. So by leveraging these international returns that we found externally, we were able to create return sequences going back using something we called rhyme and regress. First of all, we kind of had this envelope of what international large cap should have done and emerging markets should have done going back to 1970 based on the return data we could get. But then the question is, because that was fairly coarse, well, what happens on a monthly basis? What are the monthly returns, and what are the monthly returns for the sub asset classes that we don't have available to us? And so for that, we did two things. We first of all figured out, based on the return sequences we had, what would a mathematical model be? When U.S. small cap value, large cap blend, and large cap value are doing this, what has international small cap value done in the past? And you can build a mathematical model that will help you predict when you don't have an actual return. So we did that. That was the regression. And then the second thing we did was we said, well, sometimes the past is going to look almost exactly like the future. There'll be a time where you can say, well, large was a good return, blend was a good return, value was a small return, small was a small return. This is how I would match that. So I have that same pattern in the past. I can look for a rhyming return in the future. So working with those techniques, Daryl and I, we built a history that goes back to 1970 and fills in the asset class gaps with what we think is more representative data. It preserves more of the premiums for size and value internationally, going back to that point in time. It still respects these envelopes of returns that were available to us publicly. And we're going to be using that I used it already in the AAII presentation I did this year, but we'll be using it in 2021 and going forward to hopefully provide a more realistic view of what the history would have been, even though you can't get asset class histories for all of those years, but what the history would have been, which is all we can ever do with a back test, right?
Right.
So that we think it's going to help. Daryl, you want to add anything to that?
Yeah, a couple of things. I think I think the point of the ultimate buy and hold tables, for example, isn't to say this is what you would have gotten had you been able to do this. It's to show you how addition of asset classes can help improve performance, reduce volatility, and those kinds of things.
Yep.
The other thing that I would point out is that when we add these new returns into the mix and we generate the updated tables this next year, they will be different, a lot different than what you've seen in the past. And I think that what that shows is, I think it's more representative of the kinds of returns you would expect to see for the different asset classes in the mix that we have for the four fund portfolio, for the ultimate buy and hold, and for the other portfolios. So we use it to increase our history or return sequence data.
And people shouldn't get too hung up on the fact that they are different. None of these will ever be perfect. Even the academics change the return sequences periodically. They go back and they update their understanding of what the S&P 500 holdings would have been in a year where they were predicting what it was because the S&P 500 didn't exist. There's assumptions in there about expense ratios. We're trying to come up with an indicative set of data that helps guide people and set reasonable expectations based on the best understanding of the past that we have. But it's not a perfect understanding of the past, and it's certainly not a perfect predictor of the future. It's just suggestive.
Right.
So I think it's an improvement. And just to give you an idea of how it played out, when you used your historical data for the AAI presentation, and some of it you just showed, it said that the US four-fund solution would have outperformed the international four-fund solution.
Right.
And when I extend back the data using this Riemann regress process, it flips that around a little bit. It
Yes.
says that the international four-fund solution would have done a little bit better. I think that's all within the uncertainty of the process.
Right.
There's that much uncertainty in the process. Yeah.
Exactly.
Can I just throw one thing in that I was happy to see that you guys had done this. Our results back in the early 70s, when you think in terms of global diversification, really didn't represent what happened in the 70s because our results were heavily impacted by US returns. And as we know, and lots of people know, in the 70s was really the superior returns came out of the international market, but we weren't reflecting that. And of course, that's one of the reasons we like having those asset classes together, is that you do have periods, whether it's because of currency changes or because of economic factors, whichever it might be, can make the diversification better. In fact, I think that's part of what you want to talk about as well, Chris, is this question about international diversification versus just depending on the U.S.
Yeah, I think that for many people, this is another behavioral finance question. It's, what are you comfortable with? But the academics say you should reflect the market capitalization of the worldwide markets, which would have you at approximately 50% in the US and not have more concentrated risk than that, because you're not going to be rewarded for it. There's always idiosyncratic risk with any concentration. And if you chose, for example, to be 100% in the US, if God forbid something catastrophic were to happen to the US equities markets, you're 100% exposed to that. If instead you have broad diversification, then you're protected. And when we sometimes think of these things as three asset classes: emerging markets, US market, international markets, right? Well, the international market is what, 50 countries? It's huge. It's very sliced up, right? So when you add that international diversification, you're really spreading out that idiosyncratic risk. And I think it behooves most people probably to push the comfort zone a little bit more in the direction of being internationally diversified, because over the long haul, it shouldn't hurt your returns, and it should help your smooth out the ride and protect you. It's a form of protection.
So another topic, Chris, that lesson we learned came late in the year, actually, I think, and that is around the impact of using with your two funds for life strategy, looking at using the strategy later in life. You want to share some of that, even though it's you're probably going to go into it next year again, but hit us with it now, if you would.
Yeah, when I did the AAII presentation in October, one of the things that I ran was a series of retirement scenarios using two funds for life. And starting at age 60, if you use the 2 funds for life with the 1.5 times age multiplier, well, at age 60, 1.5 times age is 90. You've only got 10% in your second fund, and it's ramping down to zero by the time you're age 66-ish, 66 and 2/3. So my expectation was, well, this isn't going to make much of a difference at all. And I was really surprised, because if you were 100% in the target date fund, you had a small chance of running out of money with a 4% fixed withdrawal rate starting at age 65 and being retired for, I think it was 35 years. I'd have to go back and check. So just adding that little sliver into small cap value, going from 10% down to 0% over those years, 60 to 66 and 2/3, so almost 7 years, you ended up with a 3% higher median real end balance. You ended up with a 100% 40-year survival rate instead of 98%. So, whether you're retired for 40 years or not, let's hope you are, but maybe for some people that's academic. You also ended up with 0.3% higher safe withdrawal rate. Now, if you think of 4% as a baseline safe withdrawal rate, 0.3% is almost a 10% pay raise in retirement, right? So just for that little sliver, you ended up with a better outcome, and you end up with the same or smaller drawdowns. And so I think it helped me validate the idea that, even if all you're willing to do is go from, where you are to a little bit of an appreciation of the value of more equities versus fixed income, or a little bit of a tilt to small in value versus no tilt to small in value, it's likely to help you out. And I think that for people listening to us who are trying to find their way, I think that's really sound advice. Try a little bit, right? Try a little bit and stick with it over the long haul. And I think it's very, very likely it's going to help.
That's great. Well, I am just going to focus quickly on what I learned this year in the process of writing the book with Rich Buck. And it really was, in a way, surprising to me that when we set out to find in our book, by the way, if you don't know the title, it's We're Talking Millions, 12 simple way. Oh, there it is. 12 simple ways to supercharge your retirement. That's wonderful. Thanks, Daryl. I hope that if you've got somebody in your life that you think would be helped by this book, have them read the reviews of the book, because I've been blown away. I do recognize some of the names, and I'm not surprised they were kind enough to write a nice review, but I don't know most of the names, and the reviews have really been good. But here is the interesting aspect of this book. There is nothing new in this book. There's nothing, when I say there's nothing, well, take that back. The last half of the book is about Chris's 2 funds for life. And, but we've been writing about that now for what, about 2 years? Would it be, Chris? Yeah. So in essence, what it is, it's a book about what we would consider to be common sense investing. And I ask, why has it gotten the kudos that it has? And I think it's because people don't understand the impact of a lifetime of additional rates of return. So when we say 12 ways to increase your portfolio value by $1 million, you can imagine the kinds of disbelief that come back from that kind of a comment. You mean I should expect to have $12 million? Well, actually, it's more than 12 million, because the idea is each of these steps is a choice between doing something one thing or another. And just that difference between one thing or another can be $1 million. I'll just give you one example: the difference between stocks versus bonds. If you made a decision as an investor, and a lot of people do, to put your money someplace safe versus being in the stock market, forget about small cap value, just the S&P 500, that difference, when you look at 10% compound rate of return, who knows, but that's the last 92 years, versus 5%, which is the last 92 years in government bonds, that difference of 5% is actually, if you invested $6,000 a year for 40 years and you lived off of it, and then you left it, that difference would be a $10 million difference in what you spent and what you left. And that is, I think, a message that just simply comes as a surprise to people, that those simple decisions, not stocks versus bonds, it should be an easy one for young people, but it isn't. And hopefully this book will make it that. And that is true of all of the rest of the information in the book. All common sense. But we have to realize, and I have to, by the way, I have this with my diet that I've been on since the 5th grade. Every time I sit down to have a meal, there it is. Carb or what? Should I be doing the vegetables? Or if I am I doing greens, or am I doing those? Oh, look at those potatoes. See, I mean, this is the reality. We all face these forks in the road. We all know to exercise or not to exercise has implications. Well, those same implications are real inside of your portfolio. And all we're trying to get people to do is to make better decisions. And if we can get all the decisions, all the major decisions done right, it's a life changer. And I think people are seeing that in the book. Now, I did have some other thing. Now, one more thing I was going to cover, but they're going to yell at us. Aisha's going to yell at us that we talked on and on and on, and nobody wants to watch us talk on and on and on. I know what I'd like to hear from you both very quickly. What do you got planned for next year? I mean, here for the foundation, what do you got planned? Chris, what do you got?
Let's see. I've got the updated best in class ETFs. Those are going to come out in January. And I'm really excited that we now have enough history to give the Avantis funds a good look. And I'm excited that the Avantis funds are available at M1 Finance. They weren't a month ago or 2 months ago. So they're looking pretty good. I would expect you're gonna see some of those in our recommendations. The other thing is I'm going to be doing some stuff around 2 Funds for Life 2.0. I've got some interesting ideas about ways to extend the 2 Fund for Life strategy into retirement using a kind of a fine-tuning approach along the lines of what you do using the ultimate buy and hold, where you pick your level of equity and fixed income. The difference here would be you're kind of picking a floor for your second fund. So instead of going all the way to 0 on the second fund, I'm doing some analysis around what happens if you say you go down to 10% in your second fund and hold it at 10%. And there's also some work around simplifying with the rebalancing in the withdrawal years. So I think there's some cool stuff coming there. And I'm also working on my book, and I'm starting to get especially with this 2 Fund for Life 2.0 idea, I'm getting a really clear idea of what that should be. So hopefully the book gets finished, the writing finishes in Q1, and then the rest of the year is turning the crank to get it out. But yeah, I think 2021
a working title.
Just working title would probably be 2 Funds for Life, a quest for simple, prudent, long-lived investing strategies. Yeah.
Oh, that's great. That's great. All right. And thank you for all you do for all the folks who are following the work at the foundation, Chris. It's very valuable. And Daryl, thank you as well. It's all so helpful, and none of it is stuff I could do on my own. And you guys are not only smart, but you're great fun to work with. What do you got on your list for next year?
Well, after the first of the year, when we have access to the data, we'll be updating the ultimate buy and hold and the associated tables and portfolios with that, not for the returns in 2020, but also rolling in the Ryman regress returns from Chris. So we'll have a whole brand new set of returns, particularly in the early years, plus the addition of the 2020 returns for the year. I've also got on the table that I've always wanted to spend some time looking at retirement withdrawal strategies and survival rates, and how does asset allocation and time horizon play into that. So we'll be looking at that a little bit. And then I also have done a little study on if you want to consider nominal returns and nominal values, what should you use for an inflation rate? And so I've done a little study on the last 90 some odd years, 95 years of inflation, and how does that play out over various time horizons in terms of rates for long-term planning of your inflation rates.
Terrific. That's great. And I have a couple of projects. One is to help more people learn about our We're Talking Millions book. I'm going to start teaching high school and college classes. I'm going to try to hold myself to no more than one a week, but I already have one opportunity where I'll be able to speak not only to the students, but their parents at the same time, which is very exciting to me. We have an audio book coming this next year. I really can't take credit for it because Don McDonald is in the following days, the final days of having that ready. I want to do a series of short videos, probably 5 minutes, or 5 to 8 minutes on I would guess 15 to 20 important decisions, and it would be aimed at first-time investors. So we're going to try to, you can tell when you listen to what Daryl and Chris are working on, what I'm working on, our focus is all ages, all stages of investing, from the very first day that you start till you get into retirement, and then into what you leave behind for others. Those are all concerns that we have. And I just got to say, on behalf of the three of us, including the rest of the team, Margie and Aisha and Renee and Jen and Rich Buck and all the rest of the folks out there that are helping us get our message out. Thank you very much. I do wish you all a very happy new year. It's good. I just know it's going to be a better year for our country, and we want to be there to help you with that important financial part of it. So you test us, you give us some good work to do, and we'll do our best to get it done. So thanks. And again, for the people that refer others to our work, for the people who have donated to the organization, to the people who have donated time to the organization, there are so many people we owe our existence to, but to all of you and our spouses. We all have spouses that their lives are compromised because of all this work we do. Thanks to them as well. So we'll see you soon. I'm sorry this wasn't one of those quick and dirty end of the year presentations, but my hope is it gave you something solid to kind of build the next year's worth of information and make you a better investor. Thank you. Thanks, guys.